If your bank legally forces you to buy critical illness insurance to secure a business loan, the CRA completely bans you from deducting those premiums. Welcome to video 6 of our 10-part series, where we dismantle the most expensive misconceptions in Canadian corporate life insurance and tax planning. Let's start with a common scenario. A successful physician or business owner applies for a massive commercial loan to purchase new equipment. This contract shows exactly how the bank approves the financing. They impose 2 strict conditions. The borrower must pledge a life insurance policy and purchase a $5,000 critical illness policy as collateral. The borrower pays those premiums directly to satisfy the bank's mandate. Because the bank required both policies to secure the business financing, the taxpayer logically assumes both premiums are standard deductible business expenses. That logic makes perfect commercial sense. It also creates one of the most common and financially devastating corporate tax traps in Canada. The confusion stems from a very specific, narrow exception in the Income Tax Act, known as paragraph 21E.2. This flowchart illustrates how that exception works. When a restricted financial institution demands a life insurance policy as collateral, the tax code converts that premium into a partial tax deduction. But notice how this mechanical valve restricts the flow. The deduction is capped by the net cost of pure insurance, or the pure mortality cost of the policy, and then prorated to the actual amount of the loan. The CRA relies on a rigid statutory definition of life insurance to allow that exception. Accident or sickness products simply do not qualify. That means critical illness and disability insurance policies fail to meet this federal definition entirely. Because they fail that definition, they fall under a much harsher federal default rule, paragraph 18(1)(b). This sorting system assures the result. Under 18(1)(b), critical illness and disability premiums are classified as capital expenditures. They are immediately diverted into a red, non-deductible bin, effectively banning the write-off. The CRA does not care if the policy was an absolute requirement to keep your business operating. They only enforce the rigid statutory category. To see exactly why seasoned accountants fall into this trap, we have to look at a geographic anomaly in the province of Quebec. At the 2022 APFF Roundtable, Revenue Quebec confirmed a surprising leniency. Critical illness premiums can be deducted as a guarantee expense under provincial tax rules. This map highlights the resulting collision. While Quebec lights up green for provincial deductibility, the CRA issued an immediate rebuttal at that exact same roundtable, slamming down a heavy red grid over the entire country to enforce the federal ban on CI and disability deductions. Practitioners operating in Quebec face an extreme danger. They read the provincial rules, correctly apply the provincial leniency, and mistakenly carry that exact same deduction over to the federal tax return. A financial strategy can be a perfectly legitimate business expense in one jurisdiction and a strict violation in another. Let's bring this back to our physician to calculate the exact financial consequences of conflating the bank's rules with the CRA's rules. Looking at this corporate tax ledger, writing off the life insurance premium might survive an audit, but claiming that $5,000 critical illness premium is flagged instantly as a direct federal tax violation. The CRA denies the deduction immediately. That triggers a demand for back taxes owed, which then incurs compounding interest penalties, ballooning the cost far beyond the original premium.
The fact that a lender packages life, CI, and disability together into a single mandatory collateral requirement does not force the CRA to treat them as a single deductible expense. Take a hard look at your own collateralized loan agreements. You need to ensure you haven't inadvertently claimed illegal critical illness or disability premiums on your corporate return. Have you encountered this collateral trap in your own business loans? Let us know in the comments. Hit like, subscribe, and join us for video 7, where we tackle the next major wealth-building myth.